Hello, welcome to Capital Sensei. Today, we're going to dive deep into one of the most important books ever written for an investor, or really, for anyone living in the modern world, Fooled by Randomness by Nassim Taleb. We'll break down his core ideas, like the massive, hidden role that pure luck plays in what we call success, the psychological traps and biases that make us see skill where there's only chance, and most importantly, how you can use this knowledge to make better decisions with your money and in your life. As we go through this, I'm sure you'll have questions, or maybe even stories of your own where you've seen randomness at play. Whenever we can, we try to answer questions in the comments. So please, feel free to share your thoughts, your doubts, and your experiences. It helps create a community where we can all learn from each other. All right, let's get started. Imagine two neighbors, both work in finance. Let's call them John and Robert. John has had a spectacular decade. His portfolio has returned 20% year after year. He lives in a bigger house, drives a fancier car, and is featured in a local finance magazine as a market wizard. Robert, on the other hand, has had a much more modest run, making a steady but unspectacular 6% a year. We look at this, and the conclusion seems obvious. John is a genius, and Robert is mediocre. But Nassim Taleb would ask us to pause and consider another possibility. What if John simply got lucky? What if his strategy was to make incredibly risky bets that by sheer chance paid off? And what if Robert's strategy was a carefully constructed, risk-averse plan that was designed to weather any storm? For 10 years, John looks like a hero. But in year 11, a sudden market crash, an unexpected event, wipes out John's entire portfolio, and then some. Robert, meanwhile, takes a small hit but is otherwise fine. Who was the better investor? This little story is the heart of Fooled by Randomness. The central idea is that we are biologically and psychologically wired to misunderstand randomness. We see a successful outcome, and our brain immediately searches for a cause, a reason, a story. We attribute it to skill, intelligence, and talent. We rarely, if ever, attribute it to what it very often is: pure, dumb luck. This is especially true in fields governed by huge amounts of chance, like investing. Taleb isn't just an academic throwing theories around from an ivory tower. He was a quantitative trader and a hedge fund manager for decades. He spent his career in the trenches of the financial markets, making and losing millions of dollars on the probabilities of rare events. He saw firsthand how brilliant PhD-level intellects could build models that looked perfect on paper, only to be blown up by something they never saw coming. His work is born from real-world scars, not just classroom theories. One of his most powerful analogies to explain our blindness to randomness is the story of the turkey. Imagine you are a turkey. Every single day, for 1,000 days, a friendly human comes to feed you. He gives you food and shelter. Every day that passes, your confidence grows. You build a statistical model based on the evidence. The evidence is overwhelming. This human loves me and is here to ensure my well-being. Your feeling of safety is at its absolute peak on the day before Thanksgiving. Then, the butcher arrives. What went wrong for the turkey? Its mistake was believing that the past was a reliable predictor of the future. The absence of a disaster in its history did not mean that a disaster was impossible. For the turkey, the arrival of the butcher was a black swan event, an event that is completely outside the realm of normal expectations, has an extreme impact, and is only explainable after the fact. Beforehand, it was unthinkable. Afterwards, everyone can explain why it happened. This is a terrifyingly accurate metaphor for financial markets. A company might have 100 years of stable dividend payments. It seems like the safest investment in the world. But that 100-year track record offers no guarantee about year 101. The world can change in an instant. A new technology, a war, a pandemic. A black swan can land and completely rewrite the rules. Trying to predict these events is a fool's errand. The key, as we'll see, is not to predict them, but to be robust to them. This leads us to one of the most common and dangerous mental errors Taleb highlights: survivorship bias. It's a subtle trap, but it's everywhere. Imagine you want to learn the secret to starting a successful tech company. So you study the stories of Bill Gates, Steve Jobs, and Mark Zuckerberg. You read their biographies. You analyze their strategies, their work ethic, their visionary ideas. You conclude that to be successful, you need to drop out of college, be a bit of a maverick, and have a grand vision. The problem? You are only looking at the survivors. For every Mark Zuckerberg, there are thousands, maybe tens of thousands, of entrepreneurs who also dropped out of college, also had a grand vision, and also worked tirelessly. But their companies failed. They are in the graveyard of failed startups. We don't hear their stories. We don't write books about them. We only see the winners. By studying only the winners, we get a completely distorted view of reality. We attribute their success entirely to their traits, ignoring the massive role that luck, timing, and random circumstance played. Let's apply this directly to investing, because this is where it gets really expensive. You see a mutual fund manager who has beaten the market for 10 years in a row. He's on the cover of magazines. He's interviewed on financial news channels, and he sounds incredibly intelligent. You think, this guy is a genius. I need to give him my money. But Taleb presents a thought experiment. Imagine you get 1,000 people in a stadium, and you tell them to flip a coin. Those who get tails are out. Those who get heads continue to the next round. After the first flip, 500 people are left. After the second, 250. After 10 flips, you'll be left with, on average, just one person who has flipped 10 heads in a row. Now, what do we do with this person? We would probably pull him up on stage. We'd ask him, what was your secret? What was your technique? Did you have a special way of holding the coin? A certain flick of the wrist? He might even start to believe his own hype. He might write a book called The 10-Step Method to Coin Flipping Mastery. We would celebrate his skill, completely ignoring the 999 other people who started with him and failed. He wasn't skillful. He was just the lucky beneficiary of a purely random process. This is exactly what happens with fund managers. If you have enough managers trying to beat the market, some of them, by pure chance alone, will have a string of successful years. We then call them geniuses, give them our life savings, and completely forget about the vast cemetery of failed managers who were following similar strategies but were simply unlucky. We are fooled by the randomness of the market. We mistake the lucky for the skilled. Another mental gremlin that Taleb exposes is the powerful duo of hindsight bias and the narrative fallacy. Hindsight bias is that I knew it all along feeling. Think back to the financial crisis of 2008. After the housing market collapsed, it all seems so obvious in retrospect. Of course, giving mortgages to people with no income was a terrible idea. Of course, bundling them into complex financial products was a recipe for disaster. Everyone became an expert after the fact. But before the crisis, very, very few people were sounding the alarm. The vast majority of economists, bankers, and regulators saw nothing but blue skies. The hindsight bias is dangerous because it makes us think the world is more predictable than it actually is. It leads us to believe that we, or other experts should be able to see the next crisis coming. But we can't. The world is too complex and random. This bias is fueled by what Taleb calls the narrative fallacy. Our brains are story processing machines. We crave simple, linear, and coherent explanations for complex events. Randomness is messy, confusing, and frankly, unsatisfying. A story is clean. So when a stock price goes up, we don't just accept it as a random fluctuation. We create a story. The stock went up because the company released a great earnings report. Or the stock went up because the CEO is a visionary. These stories make us feel like we understand what's going on. The problem is they are often vast oversimplifications or just plain wrong. The stock might have gone up simply because a large pension fund had to rebalance its portfolio and bought a huge block of shares, a completely random event that had nothing to do with the company's fundamentals. But the visionary CEO story is much more compelling. It makes us feel safe, like we are in control. The narrative fallacy makes us blind to the true, random nature of the world. Now, this is where things get a bit more technical, but stick with me because this concept is perhaps the most important in the whole book. Taleb introduces two imaginary worlds, Mediocristan and Extremistan. Understanding the difference between these two is the key to not getting financially wiped out. Mediocristan is the world of the predictable, the average, the mundane. Think about things like human height, weight, or calorie consumption. If you take a sample of 1,000 adult men and measure their height, the average will be somewhere around 5 feet 9 inches. If you add the tallest man in the world to your sample, he might be 8 feet tall, but he won't dramatically change the average. A single observation in Mediocristan is never extreme enough to meaningfully alter the total or the average. Things are well behaved. Now, consider Extremistan. This is the wild, untamed world where most of modern life, and especially finance, operates. Think about things like wealth, book sales, or stock market returns. If you take a sample of 1,000 people and measure their net worth, the average could be, say, $100,000. Now, add Bill Gates or Jeff Bezos to that sample. That one single observation will not just change the average, it will completely dominate it. The average will suddenly become hundreds of millions of dollars, a number that represents absolutely no one in the room. In Extremistan, a single event can have consequences so large they dwarf everything that came before. History is not a gentle, steady crawl. It's a series of long, quiet periods punctuated by massive, sudden jumps. A writer can sell 10 books a day for years, and then one day get discovered and sell 10 million copies. An investor can make 1% a month for a decade, and then lose everything in a single afternoon. The critical mistake we make, Taleb argues, is that we use the logic of Mediocristan to navigate the world of Extremistan. Our brains evolved in a world of physical threats and opportunities that were mostly of the Mediocristan variety. We are not wired to comprehend the wild, scalable randomness of Extremistan. So we make financial models based on average returns, using tools like the bell curve, which works great for measuring height, but is dangerously misleading when applied to markets. A market move that the models say should happen once every 10,000 years can happen twice in 1 week. So, how does this play out in the real world of investing? Think about the person who sells stock options for a living. Every month, they collect a small, steady premium. It feels like free money. They look at their track record. Small gain, small gain, small gain. They feel like a genius. Their returns are predictable, just like in Mediocristan. They are living on the calm, flat part of the Extremistan graph. but they are picking up pennies in front of a steamroller. One day, the market makes a sudden, violent move, a black swan event, and they are forced to pay out a massive amount, wiping out all their previous gains and possibly their entire capital. They were living in Extremistan, but thought the rules of Mediocristan applied. So what are we supposed to do with all this? It can feel a bit paralyzing. If the world is so random and success is just luck, why bother trying at all? But that's not the message. The message isn't one of despair, but of a different kind of wisdom. It's about shifting your focus from prediction to preparation. It's about building a life and a portfolio that is resilient to the slings and arrows of outrageous fortune. First and foremost, Taleb urges us to become what he calls a skeptical empiricist. This means you should be deeply suspicious of experts, forecasts, and narratives. When a financial analyst comes on TV and predicts with absolute certainty that the market will go up 10% next year, you should be skeptical. His prediction is likely based on past data, which, as the turkey learned, is no guarantee of the future. He is likely falling for the narrative fallacy, creating a simple story to explain a complex system. When you read about a genius investor, dig deeper. Ask yourself, could this be survivorship bias? For every George Soros who made a fortune betting against the British pound, how many others made the same bet and lost their shirts? We don't hear about them. Be humble about what you know and what you think you know. The market has a way of humbling everyone eventually. The second and perhaps most actionable piece of advice is to focus on your process, not the short-term outcomes. This is a huge mental shift. In any given year, you can make a series of brilliant, well-researched, logically sound investment decisions and still lose money because of bad luck. A war could break out, or a natural disaster could disrupt supply chains. That doesn't mean your decisions were bad. Conversely, your friend could throw a dart at a stock page, buy whatever it hits, and triple his money. That doesn't mean his process was good. It means he got lucky. If you judge the quality of your decisions solely by their outcomes, you'll go crazy. You'll end up ditching a sound strategy after a bit of bad luck and chasing a foolish strategy that just had a lucky streak. Instead, develop a solid, rational process for making decisions and stick to it. Judge yourself on how well you followed your process, not on the random noise of daily market movements. This brings us to the most concrete strategy Taleb advocates for dealing with Extremistan, the barbell strategy. It sounds technical, but the concept is beautifully simple. Imagine a barbell that weightlifters use. It has two heavy weights on the ends and almost nothing in the middle. Taleb says you should structure your investments and even your career in the same way. What does this look like in practice? It means you put the vast majority of your capital, say 85 to 90%, in something incredibly safe and boring. Think of it as the no-drama portion of your portfolio. This could be in things like government bonds or even just cash. This part of your portfolio won't make you rich. Its job is to protect you from a negative black swan. It's your fortress of solitude. If the market crashes, this part of your wealth is safe. You will survive to play another day. Now, with the remaining small portion, the other 10 to 15%, you do the complete opposite. You take massive, speculative risks. You invest in things with huge, explosive, unlimited upside. This could be venture capital, investing in early-stage startups, or buying speculative options. These are your lottery tickets. Most of these bets will likely fail. They will go to zero. But because you've only allocated a small portion of your capital, the loss is capped and won't destroy you. However, if just one of these high-risk bets pays off, If you invest in the next Google or Amazon when it's just a garage startup, the returns can be astronomical. A 100-to-1 or even a 1,000-to-1 payoff is possible. This is how you expose yourself to a positive black swan. The barbell strategy is designed to make you robust to the bad stuff while giving you a shot at the incredibly good stuff. You are conservative and aggressive at the same time. What you avoid at all costs is the middle part of the barbell, the medium risk investments that most people are pushed into. Things like corporate bonds or blue chip stocks that give you mediocre returns but still expose you to a catastrophic blow-up risk. Finally, Taleb's philosophy leads to a kind of modern Stoicism. The ancient Stoic philosophers taught that we should distinguish between what we can control and what we cannot. We can't control the weather, the economy, or other people's actions. What we can control is our own thoughts, our own judgments, and our own actions. Wasting emotional energy worrying about things outside your control is the path to misery. This is profoundly true for investing. You cannot control the market. You cannot control whether a black swan event happens tomorrow. Freaking out every time your portfolio dips is a pointless exercise in self-torture. It will lead you to make emotional, irrational decisions, like selling at the bottom out of panic. By accepting the profound role of randomness, you can achieve a certain level of emotional detachment. You can focus on what you can control: your strategy, your risk exposure, your savings rate, and your own behavior. This intellectual humility is a recurring theme. The truly wise person in Taleb's world is not the one who claims to know what the future holds, but the one who admits their ignorance and prepares for a world they cannot predict. It's the person who says, "I don't know," and builds a barbell strategy, rather than the expert who says, "I am certain," and bets the farm on a single outcome. The loudest voices in finance are often the luckiest fools. Right before their luck runs out, the quiet, humble, and prepared are the ones who endure. So, when you see someone flaunting their success, whether it's in business, investing, or any other field where luck plays a big part, take a moment to be a skeptic. Ask yourself how much of that success was due to skill, and how much could be explained by pure, unadulterated randomness. When you experience a setback, don't automatically blame yourself. You may have made the best possible decision with the information you had, only to be undone by a roll of the cosmic dice. And when you succeed, have the humility to acknowledge the role that luck may have played. The world is far more random than our pattern-seeking brains want us to believe. Understanding this, truly internalizing it, is not a pessimistic or cynical worldview. It's a source of strength. It's a superpower that frees you from the emotional roller coaster of the markets, protects you from charlatans and lucky fools, and allows you to build a financial life that is not just successful, but resilient. It allows you to survive the bad luck and be in the game long enough to eventually catch some of the good luck. And in a world governed by chance, that is the closest you can get to a winning strategy.